Before we dive in, please remember this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent, and this presentation is not a substitute for professional advice tailored to your specific situation. The world of insurance is complex, so please consult with a qualified professional to review your individual needs before making any decisions. A woman named Jessica got into a fender bender. It was one of those slow-motion 5-mile-per-hour parking lot bumps. A tiny crunch, a little paint swapped. No injuries, no drama. She did everything right. She exchanged information, took pictures, and called her insurance company. She had been with them for 12 years, had a perfect driving record, and paid her bill on time every single month for over a decade. She had what they call full coverage. She thought, no big deal. This is why I pay them thousands of dollars a year. The repair was a couple $1,000. Her deductible was $500. She paid it, got her car fixed, and moved on. 6 months later, her renewal notice arrived in the mail. She opened it, expecting to see the usual small, annoying increase. Instead, her jaw hit the floor. Her premium had gone up by 43%. An extra $800 a year. For one tiny parking lot bump. She called her agent, confused and angry. She said, "I've been a loyal customer for 12 years. I've never had a claim. How is this possible?" And the agent on the other end of the line said the 7 words that every insurance company relies on you never fully understanding. "It was an at-fault accident, ma'am." Jessica felt powerless. She felt cheated. And she's not alone. Millions of Americans have this exact same experience every single year. They believe they are protected, they believe their loyalty means something, and they discover, often when it's too late, that the entire system is designed around a single brutal truth. Your auto insurance policy is not a safety net. It is a product sold to you through a contract that is intentionally confusing, written by their lawyers to protect their interests, not yours. And their primary interest is collecting the maximum amount of money from you, while paying out the absolute minimum required by law. They are betting you won't read the fine print. They are betting you won't understand the terminology. They are betting you won't question the renewal price. Today we are going to change that. We are going to pull back the curtain and expose the 5 most important things your insurance company is praying you never figure out. This isn't about finding some obscure loophole. This is about understanding the fundamental rules of the game they've created, so you can stop being a pawn and start making the right moves to protect your wallet and your family. By the end of this, you will know more than 95% of drivers on the road, and you will be equipped to save hundreds, if not thousands of dollars every single year. So let's get straight to it. The first and arguably the most expensive lie we've all been conditioned to believe is that loyalty pays. This brings us to the first thing you absolutely must know. In the world of auto insurance, loyalty is a myth used to punish you. It sounds crazy, right? We're taught that loyalty is a virtue. You stay with a company, they reward you. You get a little loyal customer discount, a gold star on your account. It's a complete illusion. That tiny discount is a smokescreen for a practice the industry sometimes calls price optimization or elasticity modeling. That's a fancy corporate sanitized term for a very simple strategy. Figuring out the highest possible price you are willing to pay before you finally get fed up and leave. Think about it. When you first sign up with a new insurance company, they offer you a fantastic rate. It's called a teaser rate or an acquisition rate. They're trying to win your business. They might even lose a little money on you that first year. But they're playing the long game. They know that once you're in, life gets in the way. You're busy. You set up autopay. You file the policy away and forget about it. That's when they start turning the crank. The first renewal comes. The price goes up a little bit. Inflation, they'll say. The next year it goes up a little more. Increased repair costs in your area. The year after that it goes up again. They are slowly, systematically walking your rate up year after year, testing your apathy. They have mountains of data on millions of customers. Their algorithms know exactly who is likely to shop around and who is likely to just sigh and pay the bill. The people who never check, the people who believe their loyalty is being rewarded, are the ones who get hit the hardest. They are labeled as inelastic or sticky customers. You become their profit center. That 10-year customer, Jessica, with the perfect record? She was a walking ATM for her insurance company. They knew she hadn't shopped for a new policy in over a decade. So when she had that tiny claim, they didn't see a loyal customer who needed help. They saw a golden opportunity. They used the claim as an excuse to jack up her rates to a level far beyond what the risk of that minor accident justified, betting she would just complain and then pay it, because that's what she had always done. So what is the weapon you have against this? It's incredibly simple, and it's the one thing they truly fear: you shopping your policy. The single most powerful money-saving action you can take is to compare auto insurance quotes every single year, or at the very least every other year. I know what you're thinking. It's a hassle. Takes too much time. I have to fill out all those forms. Yes, it might take you an hour. But let me ask you this. If I offered to pay you $500 for 1 hour of your time, would you take it? Of course you would. That is a $500 an hour job. For many people, that's the kind of money they're leaving on the table by not shopping around. You need to treat getting your insurance renewal like getting a bill from a contractor. You don't just accept the first price they throw at you. You get a second opinion. You get a third. You go to independent agent websites, you use the big online comparison tools, you call companies directly. You spend 1 hour once a year to keep them honest. Because the moment they know you are willing to walk away, the entire power dynamic shifts. Suddenly, you're not the loyal, sticky customer they can milk for profit. You are a flight risk. And they will either have to offer you a competitive rate to keep you, or you'll find another company that will. This isn't about being disloyal. This is about being a smart consumer. You owe these multi-billion-dollar corporations absolutely nothing. Their only loyalty is to their shareholders. Your only loyalty should be to your own bank account. So set a calendar reminder. Every year, 60 days before your policy renews, make a date with yourself to shop for car insurance. It is the single biggest key to unlocking massive savings and breaking free from the loyalty trap they've set for you. And when you start shopping, you're going to be hit with a wall of confusing terms and numbers that feel like a foreign language. Liability, collision, comprehensive, uninsured motorist, MedPay, PIP. It's designed to be overwhelming. It's designed to make you throw your hands up and just say, "Give me whatever's cheapest." And that is the second biggest mistake you can make. Because choosing the cheapest option, the state minimum, is like bringing a garden hose to a volcanic eruption. It's a catastrophic financial decision disguised as a bargain. So let's make this simple. Forget the jargon. We're going to build your policy from the ground up using a story. Picture this. You're driving home on a rainy Tuesday. The roads are slick. You're thinking about what to make for dinner when the car in front of you slams on its brakes. You react, but it's too late. You swerve, you hydroplane, and you end up in a 3-car pileup. It's a mess. Metal is twisted, glass is everywhere, and people are hurt. You thankfully are okay, but your car looks like a crushed soda can. In this moment of chaos, your auto insurance policy springs to life. It's not a piece of paper anymore. It's your financial first responder. And the very first thing it does is deal with the damage you cause to others. This is your liability coverage. Think of it as your financial shield. It protects you, your savings, your home, your entire future, from the people you accidentally harmed. It's broken into 2 parts. The first is bodily injury liability. This pays for the medical bills, lost wages, and pain and suffering of the people in the other cars. The second part is property damage liability. This pays to repair or replace their cars, and anything else you might have damaged, like a guardrail or a telephone pole. Now, this is where you see those 3 numbers like 25/50/25. This isn't a secret code. It's the rulebook for your financial shield. Let's break it down. That first number, 25, means your insurance will pay up to $25,000 for a single person's injuries in an accident you cause. The second number, 50, means it will pay a maximum of $50,000 for all injuries in that one accident, no matter how many people are hurt. And the last number, 25, means it will pay up to $25,000 for all the property damage. Here's the terrifying truth. In nearly every state, these numbers, or ones very close to them, are the legal minimum you're required to have. And they are a joke. A cruel, financially devastating joke. One ambulance ride in a few hours in the emergency room can burn through $25,000 before the doctor even gives you a diagnosis. What happens when the person you hit needs surgery? Physical therapy? What if they can't work for 6 months? That $50,000 total limit for everyone evaporates in a flash. And the property damage? The average price of a new car in the United States is now over $48,000. Your $25,000 minimum wouldn't even cover half of a new Toyota Camry. What if you hit a Tesla? Or a BMW? Or a brand new F-150? When your insurance runs out, guess who's on the hook for the rest? You are. They will come after your savings account. They will put a lien on your house. They will garnish your wages for years, siphoning money directly from your paycheck until every last penny is paid. Buying state minimum insurance isn't saving money. It's gambling with your entire financial life every time you get behind the wheel. The recommendation from nearly every financial expert is to carry at a minimum 100/300/100. And if you have significant assets like a home or investments, you should have even more, or look into a separate umbrella policy. The cost to increase your liability limits is often shockingly small, maybe just a few dollars a month, but the protection it buys you is monumental. Okay, so your liability coverage is handling the other drivers. You made the smart choice and got high limits so your personal assets are safe. But now you look at your own car. It's a total loss. Who pays for that? This is where your own coverage for your own car kicks in. And it comes in two flavors. The first is collision coverage. It's exactly what it sounds like. It pays to repair or replace your car when you collide with something else, another car, a pole, a wall, you name it. In our rainy day pileup, collision is what will buy you a new car. The second flavor is comprehensive coverage. Think of this as the acts of God and chaos coverage. It has nothing to do with a collision. This is for all the other bizarre stuff that can happen to a car. A tree limb falls on it during a storm. A deer decides to play chicken with you on a country road. It gets stolen. It's vandalized. It's damaged by hail. All of that is covered by comprehensive. Now both collision and comprehensive come with a critical component: your deductible. The deductible is the amount of money you have to pay out of pocket before the insurance company pays a dime. It's your share of the risk. So if you have a $1,000 deductible and your car needs $5,000 in repairs, you pay the first $1,000 and the insurance company pays the remaining $4,000. You get to choose your deductible, typically from $250 up to $2,000 or more. And this is a strategic choice. A higher deductible means you're taking on more of the initial risk, so the insurance company rewards you with a lower premium. A lower deductible means you'll pay less out of pocket after an accident, but your monthly bill will be higher. So which one should you choose? The answer is simple. Choose the highest deductible you can comfortably afford to pay tomorrow, in cash, without causing a financial crisis. If you have $3,000 in an emergency fund, a $1,000 deductible is a perfectly reasonable choice to save money on your premium. If you have nothing in savings, you might need to stick with a lower, more expensive $500 deductible, because coming up with more than that on short notice would be impossible. So far, so good. We've covered the other people with liability. We've covered your car with collision and comprehensive. But there's one more giant, gaping hole in our protection. Let's rewind the story. What if the accident wasn't your fault? What if the driver who slammed into you was texting, ran a red light, and had zero insurance? Or what if they did the legal thing and only had that pathetic 25/50/25 state minimum coverage? Their insurance runs out instantly. Your medical bills are piling up. You can't work. Who pays for all of that? This is where the unsung hero of your policy steps in. Uninsured and underinsured motorist coverage. This is one of the most important and tragically most overlooked coverages you can buy. It protects you from the irresponsibility of other drivers. If an uninsured driver hits you, your own policy steps in and acts like the insurance they should have had, covering your medical bills, your lost wages, and your pain and suffering. If they're underinsured, it picks up where their garbage policy leaves off. 1 in 8 drivers in the United States is uninsured. That's over 30 million people driving on the roads around you with no coverage at all. Not buying uninsured motorist coverage is betting that none of those 30 million people will ever make a mistake and crash into you. It's a terrible bet to make. These are the big four: liability, collision, comprehensive, and uninsured/underinsured motorist. They are the structural pillars of a solid policy. There are other smaller coverages like medical payments or personal injury protection, which help with immediate medical costs regardless of fault, and things like rental reimbursement and towing, which are quality of life coverages that just make a horrible situation a little less inconvenient. So, when you shop for insurance, you're not just buying a single product. You're assembling a custom-built fortress of financial protection. You are the architect. You get to decide how high the walls are, how strong the gate is, and how deep the moat runs. Your policy is the blueprint, and understanding that blueprint is the key. But knowing what to buy is only half the battle. The other half is understanding the mysterious and often infuriating factors that go into how much you actually pay for it. The price you're quoted isn't random. It's the output of a complex algorithm that judges you on dozens of factors you've probably never even thought about. And in the next part, we are going to expose the 5 biggest secrets that algorithm uses to decide if you're a safe bet or a high risk, and show you how to turn that system to your advantage. So let's pull back the curtain. Imagine the insurance industry's algorithm isn't just a calculator. It's a detective, a psychologist, and a fortune teller all rolled into one. It's not just looking at your driving record. It's building a complete psychological profile of you to predict your future behavior. And the first piece of evidence it examines, the number 1 secret, has almost nothing to do with how you drive. It's your credit score. Yes, that 3-digit number that governs your ability to get a loan or a credit card is one of the single most powerful factors in determining your insurance premium in almost every state. You might be asking, what does my ability to pay my Visa bill on time have to do with my ability to merge onto the freeway? And that's the right question. The insurance companies have an answer, and it's a cold, hard statistical one. Years of data analysis have shown them a powerful correlation. People with lower credit scores on average file more claims. They don't say you're a bad driver. They say you're a higher risk. The algorithm interprets a low credit score as a sign of financial instability. And to an insurer, financial instability suggests a person might be more likely to file a small claim they would otherwise pay out of pocket. It might suggest they'll delay vehicle maintenance, leading to an accident. It might even, in their eyes, suggest a higher likelihood of insurance fraud. It's a brutal form of financial profiling. Think about it. 2 identical twins, let's call them Mark and Mike. Both are 30 years old, live next door to each other, drive the exact same 2022 Honda Civic, and have spotless driving records. Not a single ticket or accident between them. But Mark, who is a meticulous financial planner, has an 820 credit score. Mike, an artist who struggled for a few years and missed some credit card payments, has a 580 score. When they apply for insurance, Mark gets a quote for $100 a month. Mike gets a quote for $250. Same driver, same car, same address. 150% more expensive, simply because of a number that reflects his past financial struggles, not his present driving skill. Feels unfair because, on a human level, it is. But to the algorithm, it's just math. The second secret is just as personal and just as out of your control. It's where you park your car at night. Your zip code. You could be the safest driver in the entire country, a literal saint behind the wheel who has never even thought about speeding. But if you live in a zip code the algorithm has flagged as high risk, you will pay for the sins of your neighbors. This is called territorial rating. Insurers collect massive amounts of data on every single zip code in the nation. They know the frequency of accidents, the number of vehicle thefts, the rate of vandalism, the cost of car repairs at local shops, and even how litigious the population is, meaning how likely people are to sue after an accident. So if you live in a dense urban area with narrow streets, a high rate of car break-ins, and a history of large insurance payouts, your premium skyrockets. Move 10 miles away to a sleepy suburban zip code with wide streets and a low crime rate, and even if nothing else about your profile changes, your premium could drop by 30, 40, or even 50%. The algorithm doesn't see you, the individual. It sees your address on a map, colored in red for danger or green for safe. You are paying a geographic tax. You are financially responsible for the chaos or lack thereof that surrounds your home. You're not just insuring your car, you're insuring your entire neighborhood. Now, if you thought judging you by your credit and your address was invasive, get ready for secret number 3. The algorithm judges you based on your job and your level of education. This is where it gets truly weird. Actuarial tables have shown insurers that certain professions are statistically safer than others. Who do they love? Engineers, scientists, teachers, and pilots. The algorithm sees these professions and thinks, detail-oriented, meticulous, follows rules. Who's on the riskier list? Salespeople, construction workers, and restaurant staff. The algorithm profiles them as being on the road more, often in a hurry, and potentially more stressed. And the highest risk of all? Often it's doctors. You'd think a surgeon would be a safe bet, right? But the data says otherwise. They work long, stressful hours, they're often on call and rushing to the hospital, and most importantly to the insurer, they have a reputation for being sued with high payouts. So, the algorithm penalizes them. It's a system of professional stereotyping, written in code. A PhD can literally be worth more than a high school diploma when it comes to your insurance rates, not because it makes you a better driver, but because the algorithm has decided that your educational attainment is a proxy for your lifestyle, your stability, and your overall risk profile. It's making a profound judgment about your character based on the title on your business card. The fourth secret the algorithm uses is one of the oldest tricks in the book, and it's about your love life. Are you married? If you are, congratulations, the algorithm is about to give you a discount. If you're single, divorced, or widowed, get ready to pay more. This is another one that seems completely disconnected from driving. How does a wedding ring stop you from running a red light? Again, it all comes down to statistics and stereotypes. For decades, the data has shown insurance companies that married people, on average, get into fewer accidents. The logic from their perspective is that married individuals are generally older, more mature, and lead more stable, predictable lives. They might have kids in the car, making them drive more cautiously. They might own a home, another sign of stability. A single person, in the cold eyes of the algorithm, is a riskier proposition. They might be younger, go out more at night, and lead a less predictable lifestyle. The change can be instantaneous. A 28-year-old man could be paying $180 a month. The day after he gets married, he calls his insurance company to update his status, and his rate drops to $140. He didn't take a new driving class. His car didn't suddenly get safer. The only thing that changed was his marital status. He is now, according to the data, a better risk. He's been statistically domesticated. Finally, we come to the fifth and most modern secret. It's the one that ties everything together and points to the future. The algorithm is no longer just looking at the data you give it. It's starting to look at the data you create every single second of your life. I'm talking about your digital footprint. The most obvious example is telematics. Those little plug-in devices or smartphone apps like Progressive Snapshot or State Farm's Drive Safe and Save. They volunteer to be tracked, and in exchange for their privacy, they might get a discount. These programs monitor your every move. How fast you accelerate, how hard you brake, what time of day you drive, and even if you're texting while driving. This is the algorithm watching you in real time. But it goes deeper. Insurers are becoming massive data companies. They buy consumer data from third-party brokers, the same people who sell your information to marketers. They can learn about your purchasing habits, your magazine subscriptions, and your online activities. While they can't legally use your social media posts to set your rate today, they are absolutely using data to build increasingly complex, terrifyingly accurate profiles of who you are. They want to know everything, because in their world, knowledge isn't just power, it's profit. All of these secrets, your credit, your address, your job, your relationships, your data, paint a picture. It's a portrait of you created by a machine to answer one single question. How much of a risk are you? The algorithm isn't just calculating your premium. It's calculating your life. Now you know their secrets. You know the 5 hidden factors they use to judge you. You can see how the game is stacked. But knowing the rules is only the first step. The next step is learning how to bend them. Bending the rules doesn't mean breaking the law. It means playing their game better than they do. It means understanding the system so deeply that you can make it work for you, not against you. The insurance company has built a complex machine designed to extract the maximum amount of money from you, based on a statistical picture of who they think you are. Your job is to take control of that picture. Your job is to repaint it, line by line, until it shows the one thing they can't ignore. A low-risk, responsible client who deserves the lowest possible rate. This isn't about finding a magical loophole. It's about a systematic, strategic assault on every single factor that drives up your premium. We're going to turn their own weapons against them. Let's start with the one that feels the most unfair. Your credit score. They call it a credit-based insurance score, but it's the same engine. They've decided that how you manage debt is a direct reflection of how you manage a 2-ton vehicle at 70 miles an hour. Feels like a stretch, but to them, the data is undeniable. People with lower credit scores file more claims. Period. So you can't ignore it. You have to conquer it. First, you need to become the master of your credit report. Get your free reports from all 3 bureaus, Equifax, Experian, and TransUnion. You are legally entitled to these. Go through them with a fine-tooth comb. You are looking for errors. A misspelled name, a debt that isn't yours, a late payment that was actually on time. One study found that over a third of Americans found errors on their reports. These aren't just typos, they are daggers to your score. Dispute every single error relentlessly. Every point you reclaim is money back in your pocket, not just on your car insurance, but on every loan you'll ever get. Second, attack your credit utilization ratio. This is a fancy term for a simple concept. How much of your available credit are you using? If you have a credit card with a $10,000 limit and a $9,000 balance, you are using 90% of your credit. To an insurer, this screams financial distress. It signals that you are on the edge, and people on the edge make more desperate decisions, which they believe translates to riskier driving. The magic number is under 30%. If you can get it under 10%, you're in the golden zone. Pay down your balances. If you can't, call your credit card company and ask for a limit increase. If they grant it, your $10,000 limit might become a $15,000 limit. Suddenly, that same $9,000 balance is only 60% utilization. You haven't spent or paid back a dime, but you've instantly improved your score. You've changed the picture. Next, let's talk about where you live. Your zip code. You can't just lie about your address. That's fraud, and it will get your policy canceled and could land you in a world of legal trouble. But you can be strategic. Insurance companies use your zip code to price in the risks of your neighbors. They look at the rate of accidents, lawsuits, theft, and vandalism in your specific area. If you live in a dense urban area with narrow streets and high crime, you will pay more than someone in a quiet suburb, even if you are the world's safest driver. So how do you bend this rule? If you're planning a move, even just across town, get insurance quotes for your potential new addresses before you sign a lease or a mortgage. The difference between two neighborhoods just a few miles apart can be staggering, hundreds, even thousands of dollars a year. You might find that the slightly more expensive apartment in the safer zip code is actually cheaper overall, once you factor in the insurance savings. And think smaller than the zip code. Think about your parking spot. When you fill out your quote, it will ask where the car is primarily kept overnight. A private locked garage is the gold standard. A driveway is good. Carport is okay. Street parking is the highest risk. If you have a garage but you're using it to store junk while your $20,000 asset sits on the street, you are lighting money on fire. Clean out the garage. Using it for your car can directly lower your premium because it dramatically reduces the risk of theft, vandalism, and overnight hit and runs. You are actively demonstrating lower risk. Now let's move on to your job and how much you drive. Insurers have data on every profession imaginable. They know which jobs are associated with long, stressful commutes, late-night driving, and higher accident rates. An ER doctor or a traveling salesman is seen as a higher risk than a librarian or a software engineer who works from home. You must be honest about your job, but you can be smart about your job title. Many jobs can be described in multiple ways. Are you a journalist who rushes to breaking news scenes, or a content editor who primarily works from an office? Are you a construction worker out in the elements or a project manager who oversees the site? Think about the different but still accurate ways you can describe what you do. Run quotes with a few different variations of your legitimate job title. You might be surprised at the difference it makes. The key is that it must be an honest representation of your primary duties. And your mileage. The pandemic fundamentally changed this for millions of people. If you used to commute 50 miles a day, 5 days a week, but now you work from home 3 of those days, your annual mileage has just plummeted. But your insurance company doesn't know that unless you tell them. They will keep charging you as if you're still that high-mileage road warrior. Call them. Update your estimated annual mileage. Be prepared to back it up. But this single phone call can save you a significant amount of money. You are no longer the same risk you were 2 years ago, so you shouldn't pay as if you are. But the biggest piece of the puzzle, the one you have the most direct control over before you even sign on the dotted line, is the car itself. People think that a safe car means a cheap-to-insure car. This is a dangerous and expensive misunderstanding. Yes, safety ratings from the IIHS matter. A car that protects its occupants in a crash is good. But from an insurer's perspective, that's only half the story. The other half is, what does it cost to repair this car after a minor accident? Imagine a brand new Toyota Camry and a brand new Audi A4. Both are incredibly safe cars. But the Audi is packed with sophisticated sensors, cameras, and radar systems embedded in the bumpers and grille. A simple 5-mile-per-hour parking lot fender bender that might cost $800 to fix on the Camry could easily become an $8,000 repair on the Audi, requiring specialized technicians to recalibrate all that complex technology. The insurer knows this. They have parts and labor cost data for every single model. They know that the German luxury car is 10 times more expensive to fix, so they will charge you a premium that reflects that risk. Before you buy a car, new or used, get insurance quotes for the specific models you're considering. Don't just look at the sticker price. Look at the 5-year cost of ownership, with insurance being a massive part of that. You might find that the cheaper car is actually far more expensive once you factor in the insurance. Also, check the car's theft rating. The Honda Accord and Ford F-150 are consistently among the most stolen vehicles in America. Why? Because they're popular and their parts are in high demand. Owning a car that's a magnet for thieves means you're a bigger risk, and you will pay for it every single month. By choosing a vehicle that is not only safe but also common, reliable, and cheap to repair, with a low theft profile, you are making the single biggest move to lower your insurance costs for years to come. You are proactively selecting a low-risk profile right from the start. You're not just buying a car, you're buying an insurance rate. So choose wisely. You've now fortified your defenses. You've cleaned up your credit, you've optimized your location and your personal details, and you've chosen the right vehicle. You've made your profile as clean and low-risk as possible. Now it's time to go on the attack. It's time to hunt for every last dollar of savings. It's time to talk about discounts. Discounts are not gifts. They are not rewards handed out by a benevolent insurance company. They are earned deductions that you have to actively hunt down and claim. Think of the initial quote you get as the sticker price on a car. Nobody pays the sticker price. The real price is hiding underneath a pile of discounts, and it's your job to dig them out, one by one. Most people just assume the best price is offered. That is a massive, costly mistake. You have to ask. You have to be persistent. You have to know what to ask for. So let's start with the easiest category. The discounts related to you, the driver. Are you a student? Or do you have one on your policy? If they have a B average or better, a 3.0 GPA, that's a good student discount. And it's not a few pennies. We're talking a potential savings of anywhere from 5 to 25%. Why? Because insurance is a game of statistics, and statistics show that students who are responsible in the classroom tend to be more responsible behind the wheel. So don't just tell them your kid is a good student. Get the transcript, get the report card, and send it to your agent. Prove it. Claim that money. It's yours. Along those same lines, have you taken a defensive driving course? Most people haven't unless a court ordered them to. But you can voluntarily take an approved course, often online for less than $30, and get a discount on your insurance for 3 straight years. Do the math. If the course is $30 and it saves you $10 a month, you're in the green by the 3rd month. The rest is pure profit. You're not just saving money. You're investing in a skill that makes you a safer driver, which is the whole point. But the one most people miss is the affinity discount. This is the secret handshake of the insurance world. Are you a member of an alumni association, a fraternity or sorority, a credit union? Are you active or retired military, a teacher, an engineer, a scientist, a federal employee? There are hundreds of professional organizations, clubs, and employers that have negotiated special group rates with insurance companies. These are often completely invisible. They're not listed on the main website. You have to ask, do you have any discounts for members of the American Society of Civil Engineers? Or do you have a preferred rate for graduates of Ohio State University? The agent isn't going to magically know you're an Eagle Scout. You have to tell them. This alone can shave off another 5 to 15%. Okay, so you've squeezed every drop out of your personal profile. Now let's look at your policy itself. The single biggest discount available, the king of them all, is bundling. It's also called a multi-policy discount. Insurance companies desperately want more of your business. They don't just want your car. They want your house, your apartment, your motorcycle, your life insurance. The more policies you bundle with one company, the stickier you are as a customer, and the less likely you are to leave. To get you to do this, they will offer you a massive discount. It's like the value meal at a fast food joint. The burger, fries, and drink are cheaper together than if you bought them all separately. Bundling your auto and home or renter's insurance can easily save you up to 25% on both policies. If you have your renter's insurance with one company and your auto with another, you are lighting money on fire. Period. Next are the easy ones. The low-hanging fruit. The why wouldn't you do this discounts. Paperless billing. You save them the cost of a stamp and an envelope, they give you a few bucks off. Automatic payments. You let them pull the money directly from your bank account, which guarantees you'll never be late. They love that predictability, so they reward you with a discount. Paid in full discount. This one takes a bit of cash flow planning, but it's powerful. Instead of paying monthly, you pay for the entire 6-month or 1-year policy up front. This saves the company administrative costs and eliminates the risk of you lapsing on a payment. For that, they will often give you a very significant discount, sometimes as much as 10%. If your 6-month premium is $1,000, that's $100 back in your pocket just for paying on day one instead of in 6 installments. Now let's talk about the car itself. You already chose a safe, sensible vehicle like we talked about. Now, you need to make sure the insurance company knows exactly how safe it is. Don't assume they know everything about your car from the VIN number. You need to be explicit. My car has anti-lock brakes. It has daytime running lights. It has front and side impact airbags. It has an active anti-theft system. Each of these is a separate small discount that adds up. The anti-theft system one is key. If you have a factory-installed alarm or a tracking system like LoJack, that's a discount. Why? Because it reduces the chance of a total theft claim, which is one of the most expensive claims for an insurer. So you need to itemize your car's safety and security features like you're reading a resume. This brings us to the final and most modern frontier of discounts. Usage-based insurance, also known as telematics. This is the one that makes people a little nervous, but it also has the potential for the biggest savings. Here's the deal. You agree to let the insurance company monitor your driving habits. This is usually done through a small device you plug into your car's diagnostic port or an app on your smartphone. It tracks things like how many miles you drive, what time of day you drive, how quickly you accelerate, how hard you brake, and whether you use your phone while driving. Now I know what you're thinking. I don't want my insurance company playing Big Brother. And that is a perfectly valid concern. You have to weigh the privacy trade-off. But here's the upside. If you are genuinely a safe, low-mileage driver, this is your chance to prove it with cold, hard data. Instead of being lumped in with everyone else in your demographic, you get a rate based on your actual driving. The savings can be astronomical, up to 40% in some cases. It turns insurance from a group project into an individual exam. If you're a great driver who works from home and only uses the car for weekend errands, telematics could cut your bill in half. If you're a lead-footed road warrior who slams on the brakes and drives at 2 a.m., it could actually raise your rates with some companies, though many promise they won't. You have to read the fine print. But it's an option you absolutely need to know about. It's the ultimate put your money where your mouth is discount. So let's recap the attack plan. You're going to call your potential insurer armed with a checklist. Good student? Check. Defensive driving course? Check. Member of the Alumni Association? Check. Bundling home and auto? Check. Paying in full? Check. Anti-theft system? Check. You are going to go down the list and ask for every single one. Don't be shy. Don't be timid. This is a business transaction. Your job is to get the best possible price for the coverage you need. By doing this, you are fundamentally changing the dynamic. You are no longer a passive price taker. You are an active, informed consumer who is systematically dismantling their premium. You are taking the power back. But finding every discount is only half the battle. Because a 20% discount at the most expensive company in town could still be more expensive than no discount at the cheapest. Now that you know how to get your absolute rock bottom price from a single company, you need to apply that strategy across the entire market. It's time to make the insurers compete for your business. It's time to shop around. And this is where most people get it wrong. They hear shop around, and they think it means getting a quote from Geico and then a quote from Progressive and calling it a day. That's not shopping. That's just dipping your toe in the water. We're about to dive into the deep end. To truly make the market work for you, you have to understand the 4 primary gateways to getting a quote. Think of them as 4 different doors into the insurance marketplace. Some are obvious, some are hidden, and one of them is probably a trap. Knowing which door to open and when is the secret. Let's call the first door the direct assault. This is you, the lone warrior, going directly to the websites of the big-name insurers. The Geicos, the Progressives, the Liberties. You sit down at your computer, you pull up their website, and you start plugging in your information one by one. The major advantage here is control. You are in the driver's seat for the entire process. You see every question, you input every answer, and you can tweak the coverages yourself in real time to see how it affects the price. Want to see what happens if you drop collision coverage? A few clicks and you have your answer. It's transparent. There's no middleman. What you see is what you get, straight from the source. This is also the best way to get a quote from companies that only sell directly to the consumer. Geico is the most famous example of this. You can't buy a Geico policy through an independent agent. So if you want to know their price, you have to go straight to the gecko's mouth. But the direct assault has a massive glaring weakness: time. It is brutally time-consuming. Filling out one of these quote forms can take 15 to 20 minutes, And that's if you have all your information handy, your VIN, your driver's license number, your declarations page. Now imagine doing that 5, 6, 7 times. It becomes a part-time job. And because it's so tedious, most people give up after 2 or 3 quotes. They get a price from Progressive that's a little better than Geico and they think they've won. But they've only fought 2 soldiers in an army of hundreds. You might have found a better price, but you almost certainly haven't found the best price. The direct assault gives you control, but it's a war of attrition you're likely to lose. So let's look at door number 2. The company store. This is the world of captive agents. These are the agents you see in your local strip mall with a big, famous logo over their door. State Farm, Allstate Farmers. A captive agent is, as the name implies, captive to one single company. They are an expert on State Farm products because they can only sell you State Farm products. The benefit here is the personal relationship. You have a real person, a face, and a name. You can walk into their office, sit down, and have a conversation. They can help explain complex coverages and guide you through the process. For people who aren't comfortable with websites and want a human touch, this is a huge plus. And if you have a complicated situation, maybe a DUI in your past, or you own a small business, a good captive agent can be a valuable advocate for you within that one company, finding ways to get you approved or secure discounts you might have missed online. The downside, however, is monumental. That agent works for the insurance company, not for you. Their loyalty is to the brand on their business card. They can't tell you if a competitor across the street could save you $500 a year, because they are contractually forbidden from selling you that competitor's policy. They can only offer you the best deal available from their one single company. It's like going to a Ford dealership and asking the salesman to help you find the best deal on a new truck. He'll be incredibly helpful at showing you every F-150 on the lot, but he's not going to walk you over to the Chevy dealership. Going to the company store is convenient and personal, but you are only seeing a tiny, curated slice of the market. This brings us to door number 3, the one most people don't even know exists. I call it the hired gun. This is the independent insurance agent or broker. And this right here is the single most powerful tool you have in your shopping arsenal. An independent agent is the polar opposite of a captive agent. They don't work for any single insurance company. They work for you. Their job is to represent you to the marketplace. They are contracted with dozens, sometimes hundreds of different insurance carriers, from big national names to smaller regional companies you've never even heard of. Here's how it works. You connect with an independent agent once. You give them your information one time. Then they do the work. They take your profile and submit it to their entire network of insurance companies to see who comes back with the best combination of coverage and price for your specific needs. They do the direct assault for you, but on steroids, hitting 10, 20, even 30 companies in the time it would take you to get through two. They know which companies are most competitive for drivers with a speeding ticket, or which ones give the best discounts for bundling home and auto. This is their entire job. They are your professional shopper, your market expert, your mercenary fighting on your behalf in the insurance wars. And I know what you're thinking. This sounds expensive. How do they get paid? It's simple. They get paid a commission by the insurance company you ultimately choose. But here's the key. The commission is already built into the price of the policy. Whether you buy it through an agent or directly from the company, you aren't paying extra for their service. And because they can get you quotes from so many different companies, the savings they find for you almost always dwarf any commission they might make. They are financially motivated to find you a policy you'll actually buy, and the best way to do that is to find you the best possible deal. Using an independent agent is like having a superpowered, expert version of yourself running the entire shopping process. It is, without a doubt, the most effective strategy for the vast majority of people. Now for the fourth and final door, the one that's shiny and new. The digital arena. These are the online comparison websites, sites like the Zebra, Insurify, or Gabi. Their promise is seductive. Enter your information once and get dozens of real-time quotes from different companies in minutes. It sounds like an automated version of an independent agent, and in some ways it is. It's incredibly fast and gives you a broad, high-level view of the market very quickly. You can see in an instant if you're generally overpaying with your current carrier. For a quick pulse check on the market, they can be fantastic. But you have to be careful in the digital arena. Many of these sites are not just comparison tools, they are lead generation machines. This means they make money by selling your information, your name, your phone number, your email address, to hungry insurance agents and companies. You might get a few instant quotes, but then for the next 6 weeks, your phone might blow up with calls and texts from agents all over the country. can be an absolute nightmare of spam. Furthermore, the quotes you get are often just estimates. They are teasers. The final price can change once the insurance company does a deep dive into your driving record and credit history. So while it's a powerful tool for getting a quick snapshot, it can be a messy, inaccurate, and frustrating experience if you're not prepared for the fallout. So what's the ultimate strategy? You combine your forces. You don't just pick one door. You use the ones that give you the most leverage. First, and most importantly, find a well-reviewed, local independent agent. Let your hired gun go to battle for you and see what they bring back. This will cover a huge portion of the market. While they're working, take an hour and use the direct assault on the few big companies they can't quote, like Geico or a local farm bureau. Between those two strategies, you will have comprehensively covered 95% of the market. You'll have quotes sourced by an expert and quotes you sourced yourself, ensuring no stone is left unturned. You will have created a hyper-competitive environment where every company is forced to offer you their absolute best price, or risk losing you to someone who will. You've gone from a passive consumer to the ultimate prize, forcing the entire industry to compete for the privilege of insuring you. Now you've done it. You've followed the plan. You have a stack of quotes in front of you, some from your independent agent, some from your own direct searches. But they all look different. They use confusing terms. The liability limits are written in a weird shorthand, the deductibles are all over the place, and there are a dozen little add-on coverages you don't recognize. How do you actually compare these quotes apples to apples? How do you decipher the industry jargon to figure out which policy is truly the best one, and not just the one that looks cheapest on paper? Let's cut through the noise. Comparing insurance quotes feels like trying to compare two different cars when one lists the price in dollars, the other in euros, one measures horsepower and the other measures, well, something in kilowatts. It's confusing by design, but there's a system, a simple three-step process to make it crystal clear. First, you ignore the final price. I know it sounds crazy, but looking at the big number at the bottom of the page is the last thing you should do, not the first. Instead, you look for three sets of numbers. They are the heart and soul of your policy, the entire reason you have insurance in the first place. These are your liability limits. They'll usually be written as three numbers separated by slashes, like 50/100/50 or 100/300/100. This isn't secret code. It's the absolute maximum amount of money the insurance company will pay out if you cause an accident. The first number is the maximum they'll pay for any single person's bodily injuries. The second number is the maximum they'll pay for total bodily injuries for everyone in the accident combined. And the third number is the maximum they'll pay for property damage. That means the other person's car, their fence, their mailbox, whatever you hit. Now, why does this matter so much? Because this is where a small mistake can lead to financial ruin. Let's say you have the state minimum coverage in many places, which might be something like 25/50/25. That means your insurance will pay up to $25,000 for one person's medical bills, $50,000 total for everyone's medical bills, and $25,000 for property damage. In today's world, that is terrifyingly low. A modern car, even a standard sedan, is packed with sensors, cameras, and computers. A minor fender bender can easily cause $20,000, $30,000, or $40,000 in damage to a newer vehicle. If you have a $25,000 limit and you rear-end a brand new Escalade, you are personally on the hook for every dollar of damage above that 25 grand. The other driver's insurance company will pay to fix their client's car. And then their lawyers will come after you, your savings, your assets, and even your future wages to get that money back. And that's just property damage. Medical costs are even more frightening. $25,000 for a bodily injury claim can be eaten up by a single ambulance ride and a few hours in the emergency room. If the person you hit needs surgery, physical therapy, or misses months of work, your $50,000 total limit will be gone in a flash. And then, again, they come for you. This is why the very first thing you do when comparing quotes is to get all of them to the same adequate liability level. I personally wouldn't feel comfortable with anything less than 100/300/100. So you call the agent or go online and say, "Give me a quote with 100/300/100 liability limits." Do this for every single company. Now, for the first time, you're actually comparing apples to apples on the most important coverage you have. The second thing you equalize are the coverages that protect you and your car. This is primarily your collision and comprehensive coverage. Collision pays to fix your car if you hit something, another car, a pole, a wall. Comprehensive pays for almost everything else. Theft, fire, a tree branch falling on your roof, hitting a deer. For both of these, there's one key number to look at: the deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a single cent. It's your skin in the game. Quotes will come with deductibles ranging from $250 to $2,000 or more. Here's the simple trade-off. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. It's tempting to choose a high deductible like $2,000 to save $100 a year on your premium. But this is a trap. You have to be brutally honest with yourself. If you got into an accident tomorrow, could you write a check for $2,000 without breaking a sweat? If the answer is no, then you cannot afford that deductible. A good rule of thumb is to choose the highest deductible you can comfortably pay in cash at a moment's notice. For most people, this is either $500 or $1,000. So, just like with liability, you go back to each quote and say, set my collision and comprehensive deductibles to $1,000. Now, the second major variable is the same across all your quotes. Only now, after you've standardized your liability limits and your deductibles, do you move to step 3, comparing the price and the perks. With the core coverages equalized, you can finally look at that bottom line number and know you're seeing a true comparison of cost. Company A might be $75 a month, Company B might be $90. But don't stop there. Now you look at all those little add-ons, the so-called optional coverages, and you use them as tiebreakers. Let's quickly demystify the most common ones. Rental reimbursement. This pays for a rental car while yours is in the shop after a covered claim. Do you have a second car you could use? Or access to public transportation? If not, paying a few extra dollars a month for this can save you hundreds if your car is out of commission for 2 weeks. Roadside assistance. This covers towing flat tires or jumping a dead battery. It's often cheaper through your insurance than a separate service like AAA, but if you already have AAA, you don't need to pay for it twice. Uninsured and underinsured motorist coverage. This one is huge, and in my opinion, it shouldn't be optional. This protects you when you're hit by someone who has no insurance or not enough insurance to cover your bills. It pays for your medical expenses and, in some states, your lost wages. Don't skip this. Match it to your own liability limits. If you have 100/300 for liability, get 100/300 for uninsured motorist. Then you have things like medical payments or MedPay. This covers a smaller amount of medical bills for you and your passengers, regardless of who was at fault. It's good for covering your health insurance deductible right away. In some states, you'll see personal injury protection or PIP instead, which is more comprehensive and part of a no-fault system. Finally, there's gap insurance. If you have a loan or a lease on your car, you need this. A car depreciates the second you drive it off the lot. If you total that new car a year later, your insurance will only pay you what the car is worth today, which might be thousands less than what you still owe on your loan. Gap insurance pays that difference, so you're not stuck making payments on a car that doesn't exist anymore. So here's the full playbook. 1. Get all quotes with the same high liability limits, say 100/300/100. 2. Get all quotes with the same affordable deductibles, say $1,000. 3. Now compare the annual premium. 4. Look at the remaining coverages. If quote A is $10 more per month than quote B, but it includes roadside assistance and a generous rental car policy that quote B charges extra for, then quote A is actually the better deal. You've gone from a confusing mess of numbers to a clear, logical decision. You've built your policy based on protection first and price second, ensuring you're not just buying a cheap piece of paper, but real financial security. You're now armed with the knowledge to dissect any insurance quote and find the true value. But building the perfect policy is only half the battle. The other half is paying as little as humanly possible for it. The price you're quoted isn't set in stone. It's a starting point, and insurance companies have a complex, almost secret algorithm of discounts, credits, and rating factors that determine your final price. Most people only know about one or two of them, leaving hundreds, sometimes thousands of dollars on the table every single year. But what if you knew how to unlock them all? What if you knew the secret discounts they don't advertise, and the surprising things that are quietly jacking up your rates behind the scenes? Well, that's exactly what we're about to do. We're going to pull back the curtain and arm you with the knowledge to stop overpaying starting right now. This isn't about finding one magic bullet. It's about a strategy. It's about knowing the right levers to pull and the right questions to ask. First, let's talk discounts. And I don't mean the obvious ones they flash on their commercials. We're going deeper. The most common and most frequently missed discount in a post-2020 world is the low mileage discount. Think about it. Did your commute change? Are you working from home a couple of days a week, or maybe full-time? Your car might be sitting in the driveway collecting dust instead of miles, but you're likely still paying a premium based on your old driving habits. Insurance companies aren't going to call you up to offer this. You have to be proactive. Call them and tell them your estimated annual mileage has dropped. For many people, this alone can slash 10 to 15% off their bill. It's the easiest money you'll ever save. Next, let's talk about bundling. You've heard it before. Bundle home and auto. But that's just level 1. The real savings come from deep bundling. Do you have renter's insurance? An umbrella policy? Life insurance? The more policies you bring to one carrier, the more valuable you become to them. You're not just a customer anymore. You're an investment. They know that a customer with 4 policies is exponentially less likely to leave than a customer with 1. They will fight to keep you, and that fight often translates into a much deeper, multi-policy discount that goes way beyond the standard home and auto deal. Think of it as a loyalty discount on steroids. Here's one most people never even consider: affinity groups. Are you a member of a credit union, an alumni association, a professional organization for teachers, engineers, nurses, or military personnel? Are you a member of a wholesale club like Costco or Sam's Club? Many of these organizations have negotiated special group rate discounts with major insurance carriers. This is free money you're leaving on the table simply because you're not leveraging the power of your existing memberships. Go to the websites of every group you belong to and search for member benefits or discounts. You might be shocked to find a dedicated portal that offers you a quote that's 10, 15, even 20% lower than what's available to the general public. Want another one? Take a defensive driving course. And no, not because you got a speeding ticket. Many insurers offer a significant, multi-year discount for voluntarily completing an approved safety course online. It might cost you $25 and a few hours on a Saturday, but it can knock 5 to 10% off your premium for the next 3 years. Do the math. On a $2,000 annual premium, that's $100 a year, or $300 back on a $25 investment. That's a return that would make Wall Street jealous. And here's a simple one that's pure math. Pay in full. Insurance companies love getting their money up front. It reduces their administrative costs and their risk of you lapsing on a payment. To incentivize this, they almost always offer a paid in full discount. Instead of paying monthly, if you can afford to pay the full 6-month or 1-year premium at once, you can often save another 5 to 8%. Think of it this way: you have to pay it anyway. By paying it up front, you're getting a guaranteed return on your money that's better than almost any savings account. But saving money isn't just about the discounts you get. It's even more about avoiding the hidden penalties that are secretly inflating your bill. These are the things that have nothing to do with your driving record, but can cost you a fortune. The number 1 silent killer of your insurance premium is your credit score. Now, this feels wrong to a lot of people. What does my credit have to do with my driving? But in nearly every state, it has everything to do with it. Insurers use something called a credit-based insurance score. It's not your FICO score, but it's built from the same data in your credit report. Their logic, based on mountains of data, is that people who are responsible with their finances tend to be more responsible in other areas of their lives, like maintaining their car and driving safely. They found a statistical correlation between lower credit scores and a higher likelihood of filing claims. Is it fair? That's a debate for another day. But is it real? Absolutely. A poor credit score can, in some cases, have a bigger negative impact on your premium than a DUI. It can literally double what you pay compared to someone with the same car, same address, and same driving record, but with excellent credit. This means one of the most powerful things you can do to get cheaper car insurance long-term has nothing to do with your car. It's paying your bills on time and managing your debt. Next up is your zip code. You could be the safest driver in the world with a perfect record and a garage-kept car. But if you move 2 blocks over into a different zip code, your rates could jump by 30%. Why? Because you're not just insuring your car, you're insuring your car in its environment. Insurers are pricing in the risk of your neighborhood. They look at the number of claims for theft, vandalism, fraudulent injury claims, and even weather-related damage in your specific area. If your neighborhood has a high rate of accidents or car thefts, your rates go up to cover that pooled risk, regardless of your personal driving habits. Here's a trap that snares thousands of people: a lapse in coverage. To an insurance company, a gap in your insurance history, even for a single day, is a massive red flag. It signals instability and high risk. People fall into this trap all the time. They sell their car, cancel their insurance, and then spend a month shopping for a new one. When they finally buy that new car and go to get it insured, they're shocked to find their rates have skyrocketed. The system has branded them as a high-risk driver. The solution? If you're going to be between cars for more than a few days, get a non-owner insurance policy. It's incredibly cheap and it maintains your continuous coverage history, saving you a fortune when you buy your next vehicle. And finally, let's talk about the most counterintuitive rate hiker of all, filing small claims. You pay for insurance so you can use it, right? Yes, but strategically. Let's say someone dings your door in a parking lot, and the repair is $900. Your deductible is $500. So, you file a claim and the insurance company pays out $400. Great. But here's what happens next. First, you likely lose your claims-free discount, which could be 10 to 20% of your premium. Second, the claim can trigger a surcharge on your policy that lasts for the next 3 to 5 years. Suddenly, that $400 they gave you is costing you an extra $200 a year for the next 3 years. You've paid them $600 to get $400. It's a losing proposition. The rule of thumb is simple. If the cost of the repair is less than double your deductible, think very, very hard about paying for it out of pocket. Insurance is for catastrophes, not for minor inconveniences. So now you know. You know the discounts to demand and the hidden traps to avoid. You are no longer playing their game blind. You have the cheat codes, but knowing the codes is one thing. Knowing exactly how to use them to negotiate and force companies to compete for your business. That's the final piece of the puzzle. It's time to turn this knowledge into a weapon. So let's forge that weapon. The first thing you need to understand is that your greatest leverage is not anger. It's not frustration. It is simply information and the willingness to walk away. Insurance companies rely on inertia. They bet on the fact that you're too busy, that it's too much of a hassle, that you'll just accept the 6-month renewal notice and pay it without a second thought. Our entire strategy is built on shattering that single assumption. Your battle plan has 3 phases. Phase 1, the reconnaissance call. Phase 2, the market offensive. And Phase 3, the final negotiation. Let's start with Phase 1. Before you do anything else, you're going to call your current insurance provider. This is not the call where you threaten to cancel. This is a surgical strike for information. Before you dial, have your current policy declaration page in front of you. You need to know your exact coverages, your deductibles, everything. You are preparing for battle. When you get an agent on the phone, your tone is crucial. You are not angry. You are polite, inquisitive, and maybe just a little disappointed. You're a valued customer exploring their options. The script goes something like this. Hi, my name is, your name, and my policy number is, your number. My renewal is coming up and the new premium is a bit higher than I expected. I've been a loyal customer for X years, and I'd really like to stay with you, so I was hoping you could help me find a way to lower this cost. Could we start by reviewing my policy for any available discounts I might not be getting? This opener is perfect. It frames you as a loyal customer who wants to stay. It makes the agent an ally, not an adversary. Their job is retention. You've just made their job easier by telling them how to keep you. Now listen. They'll go through the standard list. Are you a member of any professional organizations? Did you install an anti-theft device? A good student discount? Take anything you can get. But this is just the warm-up. Next, you deploy the secret weapon questions we've been talking about. You ask, I've been reading about how telematics programs can offer significant savings. Can you tell me about your program, what the average discount is, and if there's any penalty for trying it out? Then you probe their weak spot. Out of curiosity, does your company offer a loyalty discount? Or is there sometimes a penalty for being a long-term customer? I've just heard that new customers sometimes get better rates. And I want to make sure I'm being valued for my time with you. The phrasing is key. You're not accusing. You're asking a question based on something you've heard. This forces them to address the loyalty tax without putting them on the defensive. The agent will likely give you a canned answer, but you've planted a seed. You've signaled that you are not an average, uninformed customer. You know how the game is played. End the call by saying, "Thank you so much. That's really helpful information. You've given me a lot to think about. I'm going to review everything and I may call back." You have not committed to anything. You have gathered intelligence. You now have a new, slightly lower baseline premium from your current insurer. This is the number to beat. Now we enter Phase 2, the market offensive. It's time to shop. Not just casually browse but systematically attack the market. Your goal is to get at least 3, preferably 5, competing quotes. Your first stop is an online insurance marketplace, a Goliathan aggregator that forces dozens of companies to compete in a digital arena for your business. Enter your information once and watch the offers roll in. But here is the critical, non-negotiable rule. You must use your declaration page from your current policy to ensure you are quoting for the exact same coverage. Apples to apples. Same liability limits, same comprehensive and collision deductibles, same rental reimbursement. Everything. A cheaper quote is worthless if it's for inferior coverage. This is where most people fail. They get a quote that's $50 cheaper a month, not realizing it's because the liability limits are at the state minimum and the deductible is $3,000. Don't be that person. After the online aggregator, your next move is to contact an independent insurance agent. These are agents who don't work for one single company. They work for you. They have relationships with multiple carriers, including smaller, regional ones that might not even appear on the big online sites. Tell the independent agent the same thing. Here is my current declaration page. I need you to find me a better price for this exact coverage. Let them do the hunting for you. That's their job. And for your final move in this phase, you're going to pick 1 or 2 of the big-name direct insurers, the ones you see on TV every 5 minutes, and get a quote directly from their website. By the end of phase 2, you should have a folder, a war chest. Inside is your current insurer's best offer, and a stack of quotes from their competitors. It's almost certain that one of them is significantly lower. Now you have your ammunition. This brings us to phase 3, the final negotiation. This is the moment of truth. You're going to call your original insurer back. But this time you have leverage. Real, undeniable, numerical leverage. When you get an agent, you're still polite, but now you're firm. The script changes. Hi, it's your name again. I called earlier and we discussed my renewal. As I mentioned, I've been a customer for X years and I very much want to stay with your company. However, I've done some shopping around and I have a quote from competitor's name for the exact same coverage for the lower price. I need you to tell me if you can match that rate. And then, the most important part of the entire process. You stop talking. Silence. Let them be the first to speak. The agent is now in a box. You haven't been rude. You have been a smart, prepared consumer. You've complimented them, stated your desire to stay, and presented them with a concrete, competing offer. They have a choice. Lose a long-term customer entirely, or reduce the premium to keep you. Most major insurers have a special department or a set of discretionary discounts specifically for this situation. It's called the retention department, and you've just punched your ticket to get their attention. One of 2 things will happen. The agent might say, "Let me put you on a brief hold while I see what I can do." That's the sound of victory. They are going to their manager or accessing a retention tool to lower your rate. When they come back, they will likely match the offer or get incredibly close. You've just saved hundreds, maybe even $1,000 with 2 phone calls and an hour of online research. The second possibility is they say, "I'm sorry, that's the best we can do." And to that you reply calmly and without anger, "Okay, I understand. Thank you for your time, but in that case, I'll need to cancel my policy effective date of your renewal. I've already secured coverage with another provider." And you walk away. Because this is the crucial part of the winner's mindset. You cannot be bluffing. You have to be willing to switch. Loyalty in the insurance world is a one-way street. You give it, but you rarely get it back in the form of better prices. Your victory isn't in staying with one company. Your victory is in paying the lowest possible price for the best possible coverage, regardless of the logo on the paperwork. This entire process, this battle plan, is something you should do every year, or at the very least every 2 years. It is the single most effective way to control your auto insurance costs over the long term. You have now turned their business model against them. You have forced the free market to actually work for you, the consumer. You've learned the coverages, you've decoded the pricing, and now you have the exact negotiation strategy to turn that knowledge into real money in your pocket. But there is one final piece. After all this work, there is a subtle trap that can undo everything. A simple, common mistake that can cause your rates to creep back up. Or worse, leave you dangerously exposed when you need your insurance the most. Mastering the negotiation is only half the battle. You have to know how to maintain that victory year after year. And this brings us to the 5th and final, and arguably most crucial, thing you need to know about auto insurance in the USA. It's what separates the amateurs who get a good deal once From the masters who stay protected and pay the lowest possible price forever. This is the art of maintenance. Because that low rate you just fought for? It's a living, breathing thing. And if you neglect it, it will get sick, it will grow, and it will start eating your budget alive. The number one killer of a great insurance rate is something called the loyalty tax. It's a silent, insidious penalty that insurance companies count on you paying. Think about Sarah, a teacher from Ohio. For 12 years, she was with the same big-name insurance company. Her rate would creep up a little each year, maybe $10 a month here, $15 there. She'd call, and they'd give her a story about rising costs in her area, or inflationary pressures. Sounded plausible. She was a loyal customer after all. They sent her a calendar every Christmas. But one day, her nephew, fresh out of college, mentioned he was paying almost half of what she was for similar coverage on a newer car. Sarah was insulted. She thought it was a mistake. So, just to prove him wrong, she spent an afternoon getting quotes. The results were staggering. The company she'd been loyal to for over a decade was charging her nearly $600 a year more than their competitors. That's $7,000 in lost savings over that decade. Sarah wasn't being rewarded for her loyalty. She was being taxed for her inertia. Insurance companies love customers who set it and forget it. They slowly, almost imperceptibly, raise your rates over time, betting that the hassle of switching isn't worth the small increase. But those small increases compound into a fortune. Your loyalty should be to your wallet, not to a corporation that sees you as a line item on a spreadsheet. The second silent killer is lifestyle drift. Your life is not static, so why is your insurance policy? You get a new job with a much shorter commute, maybe you even work from home now. Did you tell your insurer? That's a massive risk reduction. Your mileage just dropped by thousands of miles a year. That's a discount. You finally paid off your car loan. Did you tell your insurer? The lien holder is removed, which can sometimes impact rates, and it gives you the freedom to adjust your comprehensive and collision coverages. You worked hard to raise your credit score from 650 to 750. Did you tell your insurer? As we established, in most states, that's the equivalent of going from a risky driver to a safe one in their eyes. That's a huge discount. You got married. You moved. You installed an anti-theft device. Each of these is a material change that affects your risk profile. Failing to update your insurer isn't just about potentially overpaying. It can also mean you're dangerously underinsured. Maybe you started a small side business delivering cakes from your car. If you get in an accident while on a delivery, your personal auto policy might deny the claim entirely, because that's commercial use. Your policy must be a mirror reflection of your current life, not a blurry photograph from 3 years ago. The third silent killer is the minor claim trap. This is a moment of decision that can cost you thousands. Your bumper gets scraped in a parking lot. You get a quote. It's $800 to fix. Your deductible is $500. So you think, great. I'll file a claim and insurance will pay $300. That's what it's for. This is a catastrophic financial mistake. When you file that claim, it goes on your record for 3 to 5 years. The insurer now sees you as a higher risk. At your next renewal, your premium might jump by $25 a month. That doesn't sound like much, but that's $300 a year. Over the 3 years the accident stays on your record, you've paid an extra $900 in premiums. You saved $300 on the repair, only to pay it back threefold in higher rates. You lost $600 on the deal. A good rule of thumb is to only use your insurance for what it's truly for. Catastrophic events. A fender bender is an inconvenience. A multi-car pileup that totals your vehicle and involves injuries is a catastrophe. Always do the math. Before you call your agent to file a small claim, ask yourself, is the short-term cash I'll get back worth more than the long-term cost of a higher premium for the next 5 years? Almost always, the answer is a resounding no. Pay for the small stuff out of pocket if you can. It's an investment in keeping your rates rock bottom. So how do you fight these silent killers? You don't just get a good deal. You defend it. You do this by establishing an unbreakable annual ritual. The policy health checkup. I want you to go to your phone's calendar right now. Find the date your auto insurance policy renews, and create an event 1 month before that date. Call it Car Insurance Freedom Day, or whatever you want. Set it to repeat annually. This is now a non-negotiable appointment with yourself. When that day comes, you will perform a simple 4-step process. Step 1. You will pull out your current policy's declaration page. This is your battle map. It shows your coverages, your limits, your discounts, and what you're paying. Step 2. You will review your life. Get a piece of paper and write down everything that has changed in the last year. Did you move? Change jobs? Did your credit score improve? Did your teenage son or daughter finally move out and get their own policy? Note every single change. Step 3. You will go on the offensive. Armed with your declaration page and your list of life changes, you will get a minimum of 3 new quotes from other top-rated insurance companies. Don't just go to one aggregator site. Go to the company websites directly. Be meticulous. Ensure you are quoting the exact same coverages so you're comparing apples to apples. Step 4. The final confrontation. You will call your current insurer. You will not be angry. You will be calm, informed, and powerful. You'll use a version of the script we discussed earlier. Hi, my policy is up for renewal next month. I've been a happy customer, but I've also done my due diligence. I have a quote from competitor A for the exact same coverage for X amount, and another from competitor B for Y amount. I would prefer to stay with you, but the savings are significant. Are you able to review my policy and get my rate closer to what your competitors are offering? Now the ball is in their court. They will either lower your rate to keep you or they won't. And if they don't, you will switch. No emotion. No misplaced loyalty. Just a smart financial decision. By doing this every single year, you neutralize the loyalty tax, you ensure your policy reflects your life, and you remain in a constant position of power. You are no longer a passive bill payer. You are the active manager of your own financial security. Let's bring it all home. We've covered 5 critical pillars. We learned that insurance isn't just about your car. It's about your entire life profile, from your credit score to your zip code. We learned that coverage isn't a list of expenses. It's a fortress you build around your assets, and that skimping on liability is like building a fortress with paper walls. We learned that discounts aren't just given. They are hunted, earned, and stacked. We mastered the art of negotiation, transforming a dreaded phone call into an opportunity to save hundreds, even thousands of dollars. And finally, we learned that a low rate isn't a trophy you put on a shelf. It's a garden that must be tended to every single year, weeding out the silent killers of loyalty taxes and lifestyle drift. This knowledge, this entire series, is about more than just an auto insurance bill. It's about a fundamental shift in your relationship with money and risk. It's about realizing that these large, faceless systems are not unmovable mountains. They are games. And once you learn the rules, you can play them to win. You are no longer at the mercy of an algorithm or an agent's script. You have the playbook. You have the language. You have the strategy. Your journey to taking control doesn't end with watching this video. It begins now. So I want you to do one thing for me. Right now. Sometime today, I want you to find your auto insurance policy. That stack of papers in your filing cabinet or that PDF in your email. Just find it. Put it on your desk. That is step 1. That is you taking a tangible step from being a passive observer to an active participant in your own life. And while you're at it, click that subscribe button. Because if you think mastering your auto insurance is powerful, wait until next week, when we dismantle the single biggest myth about homeowners insurance. A myth that has cost unsuspecting families their entire life savings after a disaster. You've secured your journey. Now it's time to protect your home. Don't just pay for insurance. Start investing in your peace of mind.